Today, we will talk about 5 under-the-radar stocks to buy in 2023. This video is an excerpt from the Investor Place Digest newsletter. To get news like this delivered straight to your inbox, click here. In last week's newsletter, I introduced the concept of ensemble learning, the AI version of voting for the right answer. By stringing together multiple artificial intelligence systems, software engineers can often create a more accurate final answer. 1. ArcRock. ArcRock, NYSE 8ROC, is America's largest third-party supplier of natural gas compression services. It's an essential service that helps transport natural gas from wellheads to pipelines and beyond. Older wells are particularly reliant on ArcRock services, since reservoir pressures tend to fall with age. Unpressurized gas eventually has trouble reaching collection points. Compression services are also used in refineries, petrochemical plants, and in liquefying natural gas for export. That means demand for compression services has surged in recent years. According to industry data, North American drillers have been reluctant to increase well counts, preferring instead to extract more hydrocarbons from existing wells. A rise in U.S. natural gas exports has further increased demand. That's turned ArcRock into a near hyper-growth company. Earnings per share, EPS, are expected to rise 124% this year and see another 29% jump in fiscal 2024. Analysts have also been raising their estimates, a highly bullish sign. EPS estimates for fiscal 2024 have more than doubled this year as producers double down on aging wells. That's now awarded the Houston-based firm and a grade in Lewis Portfolio Grader System, and a 14.8% expected one-month upside on TradeSmith's new intelligence models. That suggests investors should buy in before the seasonal fourth-quarter surge in natural gas prices. 2. Rover. Rover Group, NASDAQ ROVR, runs an online marketplace for pet care services, from dog walking to house sitting and everything in between. It's a business that creates natural network effects, since more providers draw in more customers and so on. Back in March, InvestorPlace.com writer Josh Enomoto chose Rover as one of his top penny stocks for 2023. It was a prescient call. Since then, a surge of return-to-office mandates had sent shares of the Uber for pet care up 60%. Busy office workers have flocked to Rover's marketplace services, and the company has seen growth surge. Analysts expect revenues to surge 30% this year and 20% annually through at least 2026. The company is also expected to turn profitable this year. That's helped Rover's score rise from a D last year to a solid B in Lewis system. A profitable 2023 will likely push shares into the A range. Furthermore, a recent pause in Rover's rise has now turned TradeSmith's new intelligence rating bullish. The system predicts that the stock will soon resume its upward trend and could rise as high as $7.83 within a month, a 14.5% upside. As office workers increasingly find themselves returning to the office, Rover will be there to take care of the pets at home. 3. Bain Capital Specialty Finance. Bain Capital Specialty Finance, NYSE BCSF, is perhaps one of the strangest growth companies to make this list. The middle market financing company invests in the debts of medium-sized firms, which is ordinarily a quiet business that generates consistent bond-like returns. However, rising rates have quickly turned Bain Capital into a high-growth company. The Boston-based firm relies almost exclusively on floating rate loans, so every 1% increase in interest rates will immediately add $10.1 million to the company's annual run rate. Analysts expect Bain Capital to grow its top line by 34% this year, and for EPS to surge 20%, where it will stay through fiscal 2024. That's put BSCF on multiple radars. Lewis Portfolio Grader System recently awarded Bain Capital and a grade for strong growth figures and positive analyst earnings revisions, and TradeSmith's AI system now believes that greater gains are coming. The new intelligence system gives Bain a 12.2% upside in a month. The company's valuations are also reasonable. Bain Capital trades at a 7x forward P/E ratio with a generous 11% dividend yield. Josh Enomoto at InvestorPlace.com once called Bain's approach, a way for investors to benefit from early-stage businesses that have tons of potential but not much capital backing. With shares trading at 17% below their IPO price, investors now have a margin of safety too. 4. Talkspace. It's been a tough several years for Talkspace, NASDAQ TLK, an online therapy company that went public in 2021. The initial excitement over telemedicine was quickly replaced with concerns over profitability. By the start of this year, the New York-based firm was losing 67 cents for every $1 of revenue and had lost 94% of its original market value. The company scored a rock-bottom F on Lewis' stock grading system. Nevertheless, a change in corporate strategy has quietly put Talkspace back on a path for growth. In Q2, the company announced its revenues had jumped 19.4% year-over-year, and net losses had narrowed from $23 million to $4.7 million. Wall Street analysts now expect 2025 revenues to hit $226 million, a 24% compound growth rate. These figures were driven by a corporate pivot to working directly with health plans, which saw a stunning 135.3% surge in Q2 revenues and abandoned its less profitable direct-to-consumer business. It turns out it's far easier to sell online psychotherapy services when insurers pay for it. This strategic change means Lewis System now awards Talkspace a solid B grade for its improving fortunes, a vast improvement since January. And this week, TradeSmith's New Intelligence joins Lewis in recommending shares of the stock. According to the AI system, investors can expect a 15% return on Talkspace's shares over the next 21 trading days. 5. Cantaloupe. Cantaloupe, NASDAQ CTLP, is a specialized payments processor that helps self-service locations collect payments. The company powers over 1 million active such locations, including vending machines, EV charging stations, and car washes. Growth at the company has recently surged as more people begin eating away from home. The company's acquisition of micro-market provider 3 Square Market, self-service convenience stores, has also opened new markets. Analysts expect Cantaloupe's net income to hit $8.8 million this fiscal year, up from zero last year, and for the figure to double yearly through fiscal 2026. That makes it one of the fastest-growing tech firms on U.S. stock exchanges. Several insiders have also recently bought shares, including Cantaloupe's CEO and a director. Studies show that these transactions are some of the most dependable signals of greater gains to come. The typical corporate insider outperforms the market by over 6% per year when transacting stock in their companies. But what do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.